Good morning, everyone. Good morning, everyone, and welcome to our webinar this morning. My name is William Didden-Leach. I'm a corporate partner in Mason Hayes & Curran. So you're very welcome to the latest in our series of built environment webinars, this morning focusing on joint ventures in the context of real estate opportunities and developments. Just as an initial housekeeping matter, we have a Q&A function, and questions can be submitted via the Q&A at the bottom of your screen. We'll try to get to as many of those questions as we can, time permitting, at the end. But so to kick off, what are we talking about when we refer to joint ventures? And not least, why are we dedicating a webinar to the topic this morning? Well, effectively, joint ventures in the real estate sector allow for the creation of a platform in which seasoned developers and financial investors come together to pool resources, complement each other's skills and expertise, and share risk in order to create successful development. Why is it important to talk about JVs now? Well, institutional capital is flowing into Ireland to follow strong investment opportunities, but it also needs boots on the ground and local developers to partner with. There are some reports from European representative bodies indicating that about 45% of real estate investors in Europe are expected to increase their allocations to joint ventures in 2022. So we're seeing and anticipating that joint venture activity is on the rise in Ireland, and it's quite literally changing the landscape of real estate development in Ireland. We have a great panel of speakers this morning to talk to a few of the topics around joint ventures, and I'll introduce them now. Firstly, we have Gary Corrigan. Gary is the managing director at Hines, and Hines is a global real estate, as many will know, a global real estate investment development and management firm with over $83 billion of investment assets under management. We also have Tony Waters. Tony is the managing director of HWBC, and HWBC advises a wide range of clients in development funding opportunities and corporate real estate strategy in office, retail, and industrial markets. We also have Nicola Byrne. Nicola is a partner in our commercial real estate department, who has a wealth of knowledge and expertise in the built environment sector, having amassed this expertise over the boom, bust, and recovery periods, and currently has a particular focus on housing developments and related joint ventures. So I think as a starting point, it's fair to say that real estate joint ventures have evolved in the Irish market over the years. And as a corporate lawyer myself, we're mainly concerned with the corporate structure of the JV and how money enters and exits the project. In terms of the corporate structures, we do see the full range of options being used, from limited partnerships, incorporated limited liability vehicles, and unincorporated contractual joint ventures. And you'll possibly be relieved to learn that we won't be dwelling on the turgid aspects of corporate structuring on this morning's webinar. But it is, of course, an important factor, as is certain the tax considerations when approaching a joint venture and the jurisdiction of the joint venture vehicle. But we won't be getting bogged down in that detail this morning. We're talking about much more interesting points and hearing from our panel on their views on those. And Nicola, so I might start with you. With your primary focus as a real estate practitioner, the focus that you have is on the real estate asset itself. From your practice in the Irish commercial real estate market, how have joint ventures featured to date over, let's say, from the pre-GFC, from the boom, the bust, and recovery periods? What have we seen joint ventures over that period?
Yeah, good morning, William. Thank you. And thanks in particular, obviously, to Tony and Gary for joining us this morning. So to answer your question, William, to how JVs feature in the Irish commercial real estate market, they certainly have evolved over the last number of years. So for anything between the structure of those JVs to the substance of those JVs, and ultimately, of course, naturally to their size. And I think at a high level, if we were to take JV agreements in the housing development or the placemaking sector, for example, if I was to say, as a real estate practitioner, what was coming across our desks, back then and now, you could probably categorize those into exactly that. So what we were looking at back in the boom, bust and recovery periods over the last, say, 15 plus years. So I think, firstly, if we look to prior to the global financial crisis, the height of the property boom, I think two particular development JVs, housing development JVs would come to mind, being Adamstown and Cherrywood. And bearing in mind at that time, 15 years ago, they were really in their infancy and right at the very early stages. So very different to the kind of agreements we'd see now, and obviously far in advance to Hines' involvement there in Cherrywood, Gary. So what you would normally see would typically be a suite of commercial arrangements between a handful of neighbouring landowners and developers joining together to say, right, who's going to do what in terms of securing planning, getting the appropriate infrastructure in place, and then building out and selling. And obviously, those agreements would document the handling of funding, which I think would be traditionally domestic retail bank development finance, and then obviously divvying out or distributing, profits and sales proceeds. So that's the kind of thing you might have seen 15 years ago. If you move on then to a number of years after the global financial crisis and the crash here in particular, obviously that period was marked by the absence of development and certainly the greater absence of development finance. So what you were mainly seeing there would be uncompleted or unfinished housing developments that may have been viable in terms of build out and sell. So what we were seeing was essentially the state, in the guise of either NAMA or the NTMA, effectively partnering with certain developers to fund those to build out and sell, obviously for the main purpose of either paying or writing down debt. And then lastly, if we look at where we are today, certainly it's a transformed market in terms of how JVs go. And I know, William, you alluded there to various kind of corporate structures and tax considerations, but what we are certainly seeing is now a more innovative and creative use of traditional property specific agreements. So we might take an alternative development agreement, the most extreme example perhaps being the PPP model, which we will all be aware of. There will also then be more bespoke licensing and licensing arrangements. And then, of course, we have the reemergence of forward purchase, some forward funding, and then sometimes typically a bit of a hybrid between those. So I think, in short, JVs are now far more common. They invariably involve international funding. And certainly in terms of the commercial arrangements, they're far more complex and sophisticated. So that's really a snapshot, I suppose, from a property lawyer's perspective. But I think, Tony, I'd be really interested to hear your view of the market and what has been out there and what's out there now.
Thanks, Nicola. Good morning. Again, you've picked up some of this, but looking back on the history of joint ventures, pre-great financial crisis, highly leveraged, typically, 100% plus or minus loan to values wasn't sustainable, but mostly done with Irish, whereas, ultimately, that wasn't sustainable. And ultimately, this led to a new generation of joint ventures where the predominant party is actually offshore, third-party private equity investors, and this has led to, where we find a more sustainable market. The offshore capital is quite interesting. It's exceptionally footloose. It's a pan-European, it's pan-global in a lot of cases, and can invest absolutely anywhere. So if there isn't suitable stock in a local market, or if the returns just aren't good enough, they can move on to different markets, different countries. In our experience, the purpose of the JV tends to dictate the investor. And in particular, the cost of capital required for the particular venture. Obviously, the higher the risk, the more expensive the capital. So if you look and say to yourself, well, what are typical JVs? Where do they fall to in terms of brackets? Develop and sell is typical one, tends to be more shorter dated projects, hence tends to have higher cost of capital. If you look at develop and hold, again, buildings will be held post-development, so they tend to have a lower cost of capital as there's a much longer hold period. Again, you get portfolio builders building up a platform, again, over a number of years, and they tend to have generally a lower cost of capital as well. Worth mentioning a slight hybrid model, and that is forward fund type deals. We all talk about them. Not many of them happen. They're quite rare. They're typically on a speculative basis, mostly been in offices. There's one in the built to rent space. Again, institutional investors, they're looking for a slightly better return for the risk. They get some rent underwrite from the developer, but in the developer's hands, much cheaper capital, and of course allows them to be, very equity light, if indeed any equity, depending on the structure of the transaction. You're seeing more JVs. Again, it's where the people are focusing on tends to be built to rent and logistics.
And Gary, over to you, and it's kind of, I suppose, Hines pursues a strategy which is based almost entirely on partnerships with the sort of international investors or institutional funds that Tony is talking about. Can you tell us a little bit about why attracting this sort of investor is so crucial now to real estate development in Ireland?
Sure. Thanks very much, William. I think there's two aspects to it that are probably important. One is the planning context by which we're working in today. So if you look back in the past, the type of developments that used to be built here, particularly focused on housing, which is where I spend the majority of my time, was 200-300 unit developments, where you had a local developer with a pretty small amount of equity in the overall capital stack. And you had an Irish bank lending the majority, if not, as Tony touched on, sometimes 100% of the capital stack. That has moved on for various reasons and for the right reasons to a situation where we have we have two issues. We have a housing crisis, which I'll touch on in a minute, but we have a planning context, which is really important. So we have government setting rules and regulations that we have to meet and targets that we have to achieve over the course of the next 10 to 20 years. One is reduction of carbon. If we're going to hit those carbon reduction numbers, we have to look at reducing commute times for people working in the city. We have to densify brownfield sites, especially if we want to become a 15-minute city, which we do. And if we're going to do all those things, we have to develop larger schemes, apartment schemes within close proximity to the city centre and to where people are working. And naturally, that means you're moving up into the scale of from 200-300 unit developments up into the 1,000 unit plus. And that just requires more capital. The other important part to focus on is what we need to do as a country to solve the housing crisis. We're being told we need to deliver 35,000 houses a year. If you look at the numbers in terms of the capital required to do that, you need approximately 11 billion a year to do that. We as a nation can only deliver, between public and private, we can only deliver approximately 3 billion, or just over 3 billion, which means we have a shortfall of 8 billion euros a year to deliver 35,000 houses a year. So naturally, if we're going to try and achieve those targets, we have to look outside the island of Ireland and attract in foreign international institutional capital going forward in order to achieve these larger scale developments. So they're the two real aspects or challenges that I see we have as a nation here.
I'm just on that, Gary. So if we take this much changed housing sector as essentially a catalyst for this altered JV landscape, and to stay on housing, Tony, we've talked about the JV landscape in terms of the social housing sector, and I'd really be interested to hear what you have to say on that. So whereas obviously JVs are prominent across all property sectors, there's huge activity in housing at the moment, obviously, with us grappling with our housing crisis. And a lot of this international money is particularly attracted to this social housing sector. You know, I think it's probably fair to say across our 70-strong real estate department over the last 2+ years, I think I could safely say on any given day that every single one of our lawyers has some social housing related transactions on their desk. So be it from aggregators of portfolios of existing stock or looking at volume new build, you know, most of those predicated on local authority and approved housing body state funded models. But it just appears to us that the money can't find the asset or the desired volume of the asset quick enough.
Yeah, I mean, I suppose it falls into a couple of categories. I mean, if you look at the single assets, there is a very active market in single schemes. sort of social housing investments typically let to the local authority, 20 years, 85% rent, consumer price index type of reviews. Annuity type of investors, very long holders, institutional, hence low yields. I mean, that's becoming more established. I think you're going to see quite a lot more of that occurring in the market. There are also quite active investors building up platforms. Airways is a good example with a local partner. You're going to see a lot more of that. And again, just to pick up Gary's point about it's a very massive sum, 8 billion shortfall. You have to sit there and say most private equity, can't really afford to hang around very large, long-dated schemes. They're just too time horizon. It's just too long. So it's quite a gap to fill.
If I could turn the discussion a little bit towards the typical role of the participants involved in real estate joint ventures at the moment. So on the one hand, you have the investors, and these are, invariably pension funds, private equity funds, or other types of active or passive investors. And then on the other hand, domestically, you have the developers and the managers. And maybe I could ask you, Gary, what really are the credentials and attributes that an investor will be looking for in a developer before it looks to tie up on any particular project that's been identified for investment and development?
Sure. Yeah, I think Tony's going to touch on it a little later. I think there's the whole model of capital light versus capital heavy. I think Hines is kind of unique in a way in that it's not so much about being capital light. Is the reason we have partnerships globally. It's to diversify from a global perspective so that we can be in more markets in any given year. So, but I think the majority of the participants here in Ireland are generally trying to bring in capital where there is that capital shortfall. But in terms of the credentials on the ground, local teams, local boots on the ground is really vital. Having an understanding of the planning system, having the connections and the relationships with the contractor market, with the broker market, and having the expertise and previous experience to deliver what are becoming much more complex and much larger developments as we move into this new realm of housing development in particular. But there's two types of joint ventures. Obviously, we have what you call one-offs, where someone will come in, an institutional investor will come in and invest with a manager once, and they're the kind of credentials you need. The other one that we get quite focused on where we can is the programmatic platform, where you will have a deal that is the catalyst for a new programmatic platform in any given market, which you can then use as the springboard to do more. And the important attribute there is obviously knowing the land market, whether it's on market, whether it's off market, and you know the landowners within your market, or it's on market and you have the relationships with the brokers. I think that's a real key factor, because what will happen is if you ring fence an amount of money with an institutional investor, they want to know that they can invest that money within the time horizon planned. And they have to have confidence that you're the right partner to achieve that for them.
Yeah. And Tony, I know you know, with a sort of a corporate finance advisor hat on, or real estate investment finance advisor, you've acted as matchmaker on many transactions before. What are the elements that you've observed that contribute to a successful partnership between the developer on one side and the investor on the other?
William, this is mostly matching expertise to available capital. There's a very wide range of capital available out there for different subsectors, and some, as you know, some sectors would be more active than others. I mean, for example, where there's little capital available is to provide equity for sites without planning permission, maybe zoned, but without planning permission. This is just seen far too way up the risk curve. We have issues again in our planning process at the moment, judicial reviews, and that's made a lot of investors withdraw from that part of the market. Retail sector is not humming at the present time. I'm not sure it's quite bottomed out yet. It's probably getting there. Opportunistic investors will certainly arrive there. Lower down the risk curve is adding floors to an office block, for example, 2 or 3 floors. There have been a few platforms that have successfully done that in the past. Just to add sort of examples of very well-known JVs, and there's quite a few of them out there. You have Marlet, M&G, Ballymore, Oxley, Bennett, Oaktree, Airways, Avestus, AXA, Kennedy Wilson, and of course, you've Heinz, of course, Gary there was APG, but there are many others.
Mm-hmm. And Gary, I know that Heinz have a very interesting allocation process, and so maybe you could give an insight into the actual process Heinz undertake in choosing the joint venture partner and bringing opportunities to those investors. So maybe you could give us an idea of the process there with Heinz.
Yeah, I suppose the country teams, as we call them within Heinz, so we have Heinz Ireland, Heinz UK, Heinz Spain, Italy, Germany, etc. We're quite lucky in that we have a dedicated capital markets team that's based out of London, but its core focus is to maintain the relationships and to stay in touch with our existing partners, previous partners that we may want to work with again, and prospective partners going forward. And how Heinz generally works is that the way that Tony put it there earlier is local expertise. So Heinz Ireland is the local expertise in this particular market. We bring deals that we think are interesting for us to pursue, and we bring them to an allocation call on a weekly basis, where our capital markets team and some of our investment committee members look at, I suppose, matching the deals that each country in Europe is presenting that week with the appropriate capital in the appropriate priority. And we have if you look at Europe rather than globally, we have European discretionary funds, we have non-discretionary European separate accounts, we have country separate accounts, we have asset-specific pan-European funds. We've lots of different pots of capital, and really what's important for our investors is knowing or having confidence in the process by which we go through to match the equity appropriately with the deals that we're pursuing in any given market. And I think from speaking to various colleagues within the industry, I think that's quite a unique proposition.
That is certainly unique, and Tony, that's obviously quite a systemized approach in Heinz, and is appropriate given its scale and global reach across Europe and beyond. But for maybe participants who have who are less, for whom a less formalized structure is appropriate, how have you seen the process take place in a less formalized and systematic way?
Right, it's for the rest of us, it's slightly different. This is it's a marriage, obviously, between capital light, which is expertise and capacity to deliver. We picked on that, and capital heavy, which is basically the money. Most capital light promoters either have their own contact basis, and some of them will have, and some won't. And others would use third-party advisors to source either a placing to a specific investor or go through a process. This is where people like ourselves come in. It takes time to get in place. Obviously, it will take maybe 6 months or so to get in place, and that's pre-legal documentation. Maybe it's more 3 to 6 months, so it does take time. I think it's important to just mention, most investors, you will want to see a co-invest, hard money from the promoter, stroke developer, to ensure their interests are aligned. So an important point to bear in mind. Time is also a major point for most investors, certainly further up the risk curve with a higher cost of capital, typically private equity. COVID delays would have hurt a little bit for obvious reasons.
Yeah.
Could I possibly ask there, in terms of this process then of choosing a JV partner, we hear a lot in the market about ESG. So I'd just be interested to hear either of your thoughts on the role played by ESG. And I suppose, just for the uninitiated, if there are such a thing, the acronym is environmental, social, and governance, obviously being the various matters and considerations that are really having an ever-growing influence in what are termed, I suppose, sustainable or ethical investments. I think Ardstone's latest new green loan facility in relation to social and affordable housing was the most recent, but I think that the kind of things that we're reading about every couple of days, it seems. So what we hear is that, although yes, ESG is the driver of certain investments. So, somebody wanting to invest in housing, which might be a solution to a housing crisis, or, for example, investing in an area of other societal infrastructural need, for example, health or education. But what our clients are really saying to us is that, in addition to being actually a driver of an investment, ESG or firms' ESG policies are really having a far more wide-ranging impact in terms of the kind of capital it can attract or the cost of that capital.
Yeah, I can cover some of that. Maybe on sustainability more specifically, where I would have the most experience, Nicola. But to give it some perspective, Heinz has just recently appointed a global head of ESG, a European head of ESG, and we've most recently just appointed an Ireland head of ESG, which is Claire Pomeroy here in our Dublin office. So it's very much growing in its importance, not just from a developer standpoint, but from the institutional capital that's looking to invest alongside. And those various funds I would have mentioned earlier on, whether it's the Heinz Core Fund, Value Fund, Cherrywood that we talked about earlier on, we've achieved global sector leader in GRESB, which for those who don't know what that is, it's the Global Real Estate Sustainability Benchmark. And we're very proud of that because we know how important it is for Heinz, but we also know how important it is for the institutional capital that we're investing on behalf of or alongside. But to give a more specific example, looking at how we're powering up buildings, previously apartment buildings would have been powered with central systems in the basement for heating and water, and they would have been run off gas. My experience is that the majority, if you take a pension fund, for example, an institutional investor like a pension fund investing across Europe, if your building is still powered or its main source of power is gas, you're going to struggle to attract that institutional capital today, and you will certainly struggle more and more as the months go by.
So, look, I think, and clearly ESG is really important across many sectors at the moment, but I thought it worth pushing on to, the parties having decided to create a joint venture. I think it would be interesting to hear a little bit about some of the key issues that are likely to come up when you're getting down to the nuts and bolts of the transaction documents. Some points will be universal across all joint venture arrangements, no matter what structure or type of agreement you use, and these points will come up again and again. So I think, Tony, I might turn to you first. Having been in the weeds on many of these negotiations, in your experience, what are the key issues and also some of the negotiation points that parties need to be thinking about in real estate when they're approaching joint venture transactions in real estate?
Yeah, there are, no particular order, William. There's 5 in our experience. Funding, which is bank debt, the exit, important piece, which we'll touch on again, obviously, control, governance, termination and step in being a big point, usually left a bit later in the process, but it's important. The promote structure probably being the most important, which is sharing of the future returns and profits. This tends to be the most important point both to investors and obviously promoters. And again, I know it's a slightly side issue. Forward fund type deals are also joint ventures, and those development agreements tend to capture exactly the same points, just slightly different.
Yeah. So taking your first point, Tony, on funding, obviously the parties to any joint venture need to be clearly aligned on how their projects are going to be funded, either from their own resources or from third-party resources. So how will they typically achieve the funding piece, and where will they go?
Yeah, it's obviously debt funds, which is basically Blackstone, sort of Brookfield, on the larger end of the scale, are really the major players going forward, as opposed to the traditional balance sheet lenders. Most use debt as part of their capital stock, or stack, I should say, to reduce the equity check required and also to enhance the returns, all which makes good sense. In development, debt typically is 65% plus or minus loan to cost.
Could I just ask you, Tony, in terms of obviously a particular interest in terms of housing development, if we even just take housing development generally, so private housing, and this new origin of debt funding, moving away obviously from the domestic development financing. And then if we move into the social and affordable housing sector, so if we look at the move of some of the top tier approved housing bodies away from being traditionally capitalized publicly by the Housing Finance Agency, to this international capital or debt. So, for example, we've seen Clúid tee up with Legal and General. We've seen Oakley do similar with the German bank Nord. Do you see a return to this Irish development finance, either alone or working in some way with this international debt capital in those sectors?
That's a good question, Nicola. Not the easiest one to answer. Our retail banks are indeed in the space of providing development finance, and it would be good to see them to have a lot more capacity. You need to remember that they have long memories themselves, and they have overexposure issues from the past, and there are now less banks, so the probability is not very high. There will be a lot more from them. I think the debt funds will continue to dominate the space and fill all the gaps. That remains to be seen. Would they do joint ventures? Maybe with the difference between senior and mezzanine, maybe, potentially. On approved housing bodies, you have to feel that as they mature and the sector grows, you have to feel there'll be other alternatives available to them, perhaps a bond type issue, secured on assets.
So, Tony, coming back to some of the key points you talked about, you mentioned exit being and an exit mechanism being an important factor to consider. How important is it to legislate for the circumstances governing an exit? So on the one hand, you will have an investor who will want visibility that it can achieve an exit at a pre-agreed juncture and divvy out the returns to its investors on the top of its fund, for example. And then the developer will also be interested to recycle its capital for other projects. So the timing and the circumstances of an exit are important. And how have you seen this play out in the joint ventures you've negotiated?
William, they'll mostly be, exit strategies will be in the basic business plan between the parties at the very start. And they will look at options. They will have a lot of questions like, what if? Their whole purpose is to maximize the exit achievable, again subject to market conditions and the real estate being completed or let, or as the case may be, to maximize that value. Their plan is to add value, obviously, so they can share the upside, and that's typically achieved, as we all know, by an asset sale. When it's ready, and that could be a single asset or multiple assets by portfolio. Typically a sale to an unconnected third party, by whatever, either off market or processed, or it can also be one party buying out the other party, by a pre-agreed structure, pre-agreed pricing basis.
I think that's an important point actually Tony makes there, William, in that I think people shouldn't necessarily, if they're trying to raise capital, they shouldn't pigeonhole themselves into one particular box. You may have an investor that you're bringing into a development here in Dublin that may want to own residential for 10 or 15 years, as an example. That doesn't necessarily mean that the promoter has to own the residential for 10 or 15 years. So you can have a mismatch of overall investment horizon, albeit you have an agreed strategy to get to a point where the project is realized. And how we often see that happening for the local developer is what we call a synthetic takeout, where you can put your minority stake to the majority investor. I know we're going to touch on promote a little bit later. You can get paid your promote, but really what that does is it allows the minority investor, the developer here in Ireland, to go and do more deals and to attract the same investor into new deals or to attract new investors. But I think it's important when sitting down with an advisor or thinking through your investment strategy and who you'd like to bring in, that you don't necessarily feel that they have to have the exact same investment horizon as you for a relationship to work.
Mm-hmm. And Gary, on the point that Tony mentioned around control and governance, and it'd be interesting to hear how you've seen this structured in your documents. Obviously, it won't be a case that the investor just gives you the money and is happy for you to manage the project free and easy and hand back something to them when it's done. So how active or how prescriptive will the investor be in this area of decision making? Is it a case that the majority investor with the majority of the investment and the interest in any project rules and takes all the key decisions, reserves all the key decision milestones, etc., to itself, and you're bound up in whatever they dictate.
Yeah, look, there's a few elements to that. There's a lot in that, obviously, and I think if the old saying goes, the most amount of failed joint ventures are 50-50 joint ventures, right? So that kind of says it all, really. But where you have a majority investor, you've got to come to the realization that control will sit with the majority, especially what you're seeing here in Ireland, where the developer on the ground here can have a pretty minimal stake in the overall capital stack from an equity perspective. But what's important then is to make sure, as you touched on earlier on, all the what ifs, you work through the scenarios in the joint venture or in the shareholders agreement, as you guys might call it, and you try and cover off as many eventualities and what happens if one of those eventualities is to come to realization. The other important one is the business plan. A lot of people don't see the business plan as a legal document. It's attached, it's appendices to the joint venture. So it is a legal document, and I think it's important people realize that. And working through the business plan in a very detailed way more is better in my mind than the business plan. Again, a bit like the joint venture itself, to make sure that there's very little scope for things that pop up that aren't covered off. And then to answer your question about kind of the relationship and reporting, we report quarterly. We also have monthly reports. We have a weekly call with our investors. I personally catch up with my counterpart in some of the joint ventures we have 2 or 3 times a week. We try to fly to where they are. They try to fly where we are, post-COVID, obviously, as much as we can. So I think it's best if the developer on the ground thinks of them as a partner versus someone that they send a quarterly report to 4 times a year.
So Tony, it seems Gary's suggesting communication is key to make sure that these control issues don't become a contentious issue, if you like. What have you seen work in practice to good effect?
Yeah, William, I totally agree. I mean, relationship is key, communication. To build up a trust, you need regular communication and success. I mean, confidence is key to the delivery of any project. It's absolutely critical. You'll find that most investors will put in some sort of the barriers is the wrong word, but tests around the line, monitoring quantity surveyor, costs, obviously, maybe a technical monitor, maybe monthly, whatever, just to keep an eye on progress. And of course, they'll be doing an ongoing financial review to see where what's cost to date.
Gary, Tony mentioned that termination is possibly one of the last remaining items to be settled in any negotiation, and obviously termination is possibly one of the more uncomfortable or emotive points of negotiation, particularly from the developer's perspective. I suppose it'd be interesting to hear some of your perspectives from negotiating these types of issues.
Yeah, it comes. There's 2 main termination events. I think there's more than that in any JV, but the 2 big ones that end up being the last 2 negotiated points in a lot of these joint ventures is without cause termination and with cause termination. With cause termination is that you, as the promoter or the developer on the ground, have done something you shouldn't have done. You've done something outside of the joint venture documents or outside of the business plan without discussing it. And that kind of speaks for itself, really. And the outcome of a with cause termination can be pretty nuclear for the minority partner or the developer on the ground, rightly so. The without cause termination is slightly different in that things change. Strategies across Europe can change for any institutional investor for a number of reasons. They may do a pan-European management agreement with someone that's operating in your market, and therefore they no longer can work with you based on that agreement. There's lots of ways it can occur. And really, as the local developer, it's vital that you and your legal team are advising you as to what are the appropriate outcomes in a scenario like that recognizes most likely that you brought the on or off market deal. You did all the underwriting. You basically came up with the proposition. You've worked on it to this point that you're at the without cause termination event. And what is an appropriate outcome for you as the developer in a scenario like that. And some things we see are, fees paid forward. It may not be 100% of the fee, but an element that recognizes that you're no longer going to earn that. Hypothetical promotes is another one. You were due to get an element of promoting the deal based on its success. That's now been removed. Coming up with a calculation that allows that to happen. So it's really important, I think, for any minority partner or developer who's bringing in a majority stakeholder into a deal, that they cover that off in a fair and kind of equitable way from day one.
And Gary, you mentioned the promote there, and obviously that's a key element to the remuneration of the developer. And not everyone may be familiar with this term, and maybe you could just give us an overview of what this is.
Sure. Look, the promote is basically a percentage of the project level profit, and another word for it is an incentivization fee. So if you take a joint venture structure that's 90-10, you as the 10% shareholder will get 10% of the profit. But should you be incentivized to get more than that by waking up every morning and thinking about how to improve the project and making sure it's the last thing you think about, when you go to bed? And really what that's the promote is around, and I know we're going to touch on different types of promote in a little bit, but that's what it is in a nutshell.
Mm-hmm. So I think to conclude, if we just take housing as an overall indicator, maybe I'll turn to you, Nicola, and ask what is the future of the joint venture in the context of housing development over the next 10 years? Can you set the scene as to where you see the opportunity for joint ventures in that sector?
Yeah, I mean, between looking at the country's Project 2040, the National Development Plan, and the government's recently announced Housing for All plan, and Gary touched on those numbers earlier, under those we need to deliver 300,000 houses, new properties over the next, between now and 2030, and that's across the entire cohort of private, social and affordable. So, I mean, in the first instance, if you look at how we're going to do that, the Land Development Agency is now on a statutory footing. It's capitalized. It's firing ahead in terms of assembling a mass state land bank for the development of housing. And ultimately, its primary function is to establish collaborative structures between the public and private sector. So, for the purpose of ultimately delivering that housing, so private, social and affordable on that land. And it's tasked in doing that under the legislation, or the means of it doing that is by establishing subsidiary SPVs and entering into various risk and profit sharing commercial arrangements with the private sector. So that's certainly a huge opportunity there in terms of JVs with the private sector. Secondly, then we have details of the affordable housing legislation and schemes announced, and this involves certain focused state funding supports specifically stated to facilitate the private sector delivering affordable housing on private land. So if I was to say in terms of the opportunities that were there for private investment in social housing 2 to 3 years ago, I would say that affordable housing is the new social housing. And then lastly, I mean, if you just even look to the Housing for All plan itself, it explicitly states that non-state sources of funding are absolutely crucial for delivering and achieving the objectives under that plan. And it again expressly references international capital markets and then also domestic and international private investment as a key role in delivering those. So I think even if you just take those three as a snapshot, I think certainly in the housing sectors, JVs have a very interesting and promising future.
Mm-hmm. And Tony, that's on the sort of the government mandated side of things. We were discussing at the outset that institutional capital from these overseas investors is also driving activity and will continue to drive joint venture activity. Is it, from your point of view, are you seeing that it is increasing, or it will continue as it has a pace or increase over the coming years?
I mean, just in terms of the background, William, there are a lot of positives looking forward. It's not an expression I particularly like, but there's a very large wall of money available across the asset classes for Irish investment and the risk spectrum. as well, which is important. Asset allocators, as you pointed out earlier, are increasing most investors' percentage of their total assets held in real estate, which means there's going to be more money available, which is good news. Investors are implementing fairly different strategies to deploy capital. The examples are core plus, value add in different sectors. Dublin, is good relative value to other European markets. It's an important point. So hence, is there a possibility of some yield compression in some sectors? The answer is possibly yes, and that will assist exits, from these joint ventures. In conclusion, I would have said in a post-COVID world, the volume of JVs can be expected to rise, and I think they'll also occur in maybe some new sectors for us. Life science might be a good example.
Mm-hmm. And Gary, JVs are really the bread and butter model of your business. Will the pipeline be remaining strong for Hines?
Yeah, look, I think so. I think we have some challenges here from a planning perspective, which doesn't help, not only in housing, but in wind energy, in data center planning applications, and large scale manufacturing like Intel. So that certainly is not helping. And why that's important is that institutional capital investing on a pan-European basis looks at lots of different types of return metrics, one being IRR. And really IRR is important if you're investing across a region like Europe, is because the job of the pension fund manager is to return the best return to the pension fund holders. That's the ultimate aim. And if an investment in one market over 2 years is hitting the same return as it is in another market over 3 years, it's better investing in the first market, right? So, and that's where it becomes important, where you see Ireland specifically with these planning issues we're seeing, it's taking longer and longer to get planning. IRR becomes more difficult over the length of the project in other markets where planning isn't such an issue. So I see the fundamentals of the Irish housing market in particular being very strong, in that we have 18,000 new jobs coming in the next 2 to 4 years. And we have an ever-growing deficit in terms of the supply of housing versus the demand.
Mm-hmm. Thanks for that, Gary and Tony and Nicola. I think we'll just move on to some brief Q&A. And actually, I have a question which, Gary, for you, in terms of, we talked about the promote and its structure. Is there a preferred structure required by the investors, or are most, you referenced IRR there, are most investors insisting on IRR-based promotes in terms of how they're structured?
I wouldn't say most investors are. I think every investor has a different view on how they want to incentivize their partner. But for the reason I mentioned earlier, it is an important metric, and how hard the money's working in one country versus another, I think, is really important. But there's various other options. I think, Tony, you've had quite a bit of experience with some investors on equity multiple. I haven't seen a huge amount of it.
Yeah, I mean, it's as you know, it's an equity multiple is a bit, it's not similar to a straight profit share, whatever percentage. So it kind of has that effect. It's more fixed return, so therefore it's not as time sensitive, as you were saying in IRR terms. However, you do see, as you'll have seen as well, you do see structures where you get the higher of either, and that's that may not be the best for the local partner, but that is a requirement of certainly higher risk capital in some cases. I think the structure to promote kind of really depends on the purpose of the JV, and its time period. If you'll basically see a priority return for the majority investor, and therefore after that it's going to be tiered into brackets for sharing between the parties to reflect the added value and the extent of added value. One of my biggest hobby horses, of course, is worked examples, as Gary will certainly know, and this is very important to ensure that everybody knows what the financials look like or could look like in certain circumstances, and hence no issues down the line. No worries.
And not all transactions are merchant build type transactions. You have investment deals, or even in build to hold deals where it's not just about a percentage of the development profit. You have what we call a running promote, where you can earn a percentage after a pref return to the majority investor on a cash on cash, as an example. So there's lots of different ways that investors like to try and incentivize the local partner.
We've a Q&A here, and it's not directed at anyone in particular, and maybe you'll both have a view on it. Do you have any views on how detailed heads of agreement should be before negotiating transaction documents?
I do, anyway. I don't know about Tony. Look, I think, again, more is best. There's a huge amount in these joint venture agreements in order to cover off what we discussed earlier around the what ifs. And again, I think your legal advisor is really important there. And most large scale institutional investors will have a playbook by which they're allowed to play. And there's things they can agree to and there's things they can't agree to. And it's having an understanding of those as best as possible, as early as possible, and capturing them in the heads of terms. You'll never capture everything. And obviously, I know, William, you mentioned it previously, you have to draw the line somewhere or your heads start to become the shareholders agreement itself. But I think spending time on the heads really saves time on the shareholders agreement down the line.
Tony?
Yeah, I'd agree with Gary on that as well. I think he's 100% right. I mean, the soft touch, heads of terms tend to leave too much unsaid, and then you have problems at detailed documentation stage. And in fact, your good selves, lawyers don't actually know what to put in, and they're looking for instructions all the time. So in fact, Gary's right. There's a happy medium, not too little, not too much. But from my perspective, getting the main commercials is critical, and understanding what they mean. And again, there is, we all hate a bit about the step in and stuff, but you're better off getting those principles up front.
I think most clients, I think most clients would like to hear that more detailed heads will also save you a lot on legal fees down the line.
Absolutely. And what we see a lot is the heads actually get attached to the shareholders agreement as one of the documents.
Provided everybody adheres to the heads, and usually you'll be waiving the heads of agreement, I'm sure, at the latter stages of any transaction, saying that, well, this isn't agreed and we're specific enough. But the important point is engage your lawyers early so that you do address all of the key negotiating points on transactions at the heads of agreement stage. Shameless plug. Look, I suppose, thanks. I think we'll wrap it up there. I want to thank our panel, Gary, Tony, and Nicola. Thanks very much for your time this morning. Thank you all to our audience for joining. Hope you found it informative. We've a feedback survey which will automatically appear once the webinar ends. So we'll be really grateful for any of your comments and feedback, as always. And we look forward to welcoming you back at our next chapter of our Built Environment series. Thank you very much.
Thanks, William. Thanks, Nicola. Thanks, Tony.
Thank you.